听见资本，本期视频为您带来的是摩根大通在3月27日录制的关于全球外汇市场话题的内容。你知道吗？特朗普的关税政策可能会让你的下一辆车贵上好几万，同时还可能搅乱全球经济和你的投资账户。这周，特朗普宣布对进口汽车加征25%关税，汽车行业瞬间炸了锅。美国、加拿大、墨西哥的汽车股票应声下跌，欧洲和亚洲也未能幸免。这不仅关系到你买车的钱包，还可能拖慢全球经济增长，尤其是对欧洲和亚洲这些汽车出口大国来说，影响不容小觑。投资者得小心了，这波关税可能让你的汽车股和相关投资缩水，甚至波及更广泛的市场。外汇市场上，美元的表现却让人摸不着头脑。按理说，关税会让全球经济承压，美元作为避险货币应该上涨。可这周美元指数几乎纹丝不动，为什么？可能是因为美联储正盯着关税带来的通胀压力，实际收益率下滑削弱了美元的吸引力。投资者得留神，美联储的下一步动作可能会直接影响你的外汇持仓，尤其是美元相关的资产。加拿大元这周反应平淡，尽管汽车行业对加拿大经济至关重要，但美墨加协定的部分豁免让冲击没那么猛烈。不过长远看，关税叠加效应可能拖累加拿大经济，加拿大元前景堪忧。欧元区相对淡定，对美汽车出口占比不大，加上财政政策调整，欧元可能扛得住压力。但如果关税扩大到20%，欧元对美元可能跌到 1.03 左右，投资者得做好心理准备。日本这边，日元短期被看多，但日本车企的全球供应链布局让它受影响较小，日元走势可能更稳。总的来说，特朗普关税这步棋让汽车行业、外汇市场和全球经济都充满了变数。投资者得盯紧政策动向和市场反应，随时调整策略，因为你的钱包和投资组合可能比你想的更脆弱。接下来是英文会议的全部内容。如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Hello and welcome to this At Any Rate podcast. I'm your host Arindam Sandelia, and I'm joined today by my colleagues Meera Chandan and Patrick Locke to discuss the outlook for FX ahead of what is shaping up to be a critical week for this whole Trump tariff story. This week we got confirmation of auto sector tariffs, which I thought was actually a pretty big deal given the heavy auto linkages throughout US, Canada, Mexico, as well as the fairly substantial auto export linkages to a host of countries such as Europe, Japan, Korea, and such. So what we got out of the equity market looked pretty textbook. Auto/transportation sector stocks fell almost everywhere. But for us in FX, I think it was odd to see the dollar mostly flat. You almost had to squint to see the DXY go up intraday, which is not what one would have expected when you were expecting material damage to the rest of the world growth outlook. So I have a theory on this. It's one that we've discussed on this podcast before. It's just that the Fed is sitting on its hands even as tariff-driven inflation pressures are rising in the US. Hence, what you're seeing is real yields falling against the dollar, and that is probably serving to blunt some of this classical anti-cyclical risk-off response that we would otherwise have gotten out of the dollar. But let's dig a little deeper into the auto tariffs themselves, and maybe Pat, turning to you first. What kind of lessons are you taking away from the tariff events this week, especially in the context of what lies ahead next week?
Yeah, thanks, Arindam. So a few things kind of come to mind in terms of what we might have learned this week. I mean, first is that I think the administration is signaling some sensitivity to negative feedback loops. I think that's kind of like most obvious in that there were ultimately some degree of exemptions on the USMCA trade partners, so Mexican specifically. Obviously, they have the most kind of like deeply integrated supply chain linkages with the U.S., so that makes sense. It also extends, recent behavior in which autos were also the first thing exempted earlier in March on the 25% tariff ratchet against Canada and Mexico. So kind of continuing this series of, selectively carving out that industry in particular. I've also noted, to clients recently that, Trump had the opportunity to tariff autos in his first term as well. But he ultimately held off. So again, just kind of like signaling some degree of sensitivity there. On top of that, kind of supporting this idea that, maybe they're not totally willing to incur costs here There were a couple comments kind of more off the cuff, I think, that Trump made this week. One indicating that there is going to be, ongoing negotiability, flexibility on the reciprocal side. So even if something is delivered, does suggest that, it can be managed to some extent. And then there was also some casual discussion about maybe taking down China tariffs if there's some kind of agreement on TikTok. So altogether, still kind of like signaling some flexibility. And again, I think that generally speaks to a certain degree of sensitivity on the negative blowback and feedback loops to the U.S. Ironically, that is counter to my second point, which is that the administration actually is willing to incur costs. And I think one of the more interesting developments this week, despite the partial carve-outs on the USMCA partners, is that obviously we're going ahead with auto tariffs and that it is a significantly large enough industry that there is going to be a macro impact. So our economists here at JP this week took down our GDP forecast in the U.S. for the year by 2 ticks and have raised core PCE forecast by 3 ticks over a year ago for 25. So taking the final year number to 3.1, reaching that 3% threshold. So this certainly feels material and again, kind of like straightforwardly being applied because of this, the auto tariff development. So even in this partially diluted or watered down auto tariff that was delivered this week, there's still going to be some costs to the U.S. cycle here. And again, I continue to stress that there's partial carve-outs for Canada and Mexico. Certainly there could have been a case for kind of complete exclusion of Canada and Mexico. That is ultimately not the case. They are going to be tariffed on content that is not originated in the U.S. specifically, which is still a decent amount of the final vehicles that they export to the U.S. So altogether, it still seems like this is a fairly material ratchet in the broader sectoral tariff process. So that's my second takeaway. Quick third and fourth takeaways. Third, I think they are moving fast. This signals to me that the administration continues to be fairly aggressive on the tariff front. Specifically, the auto tariffs were kind of front loaded ahead of the April 2nd deadline, the broader Liberation Day that's being discussed. And that was kind of like concurrently with copper tariffs, also reportedly being accelerated there in the investigation process right now, but it looks like that's going to be complete much faster than kind of prior 232 investigations. So all of this seems pretty serious on the sectoral front. And then finally, fourth, I'd say, it does seem like perhaps we're skewing towards a relatively harsher stance on non-USMCA trade partners. And again, USMCA guys are not fully exempted, but at the same time, we're looking towards next week to see if there's a little bit more punitive action on Europe and Asia. They were not carved out from the auto tariffs, and then could get swept up next week in kind of the more broader assessment of the tariff and non-tariff barriers that are currently being reviewed by the USTR, Commerce Department, and the like. So I think those are kind of the main takeaways that I got from this week, Arindam.
Yeah, no, fully agree with you, especially sitting here in Asia. I think there is a bit of trepidation as to what's coming down the pipe, especially, knowing that China had an entire section dedicated to it and that inauguration, the executive order. So we can hear about not just tariffs and potential reciprocal tariffs in response to non-tariff barriers, but also what happens to the PNTR status in regards to China. So, next week is pretty critical on that front. But for state-setting stateside, for you on the Canadian dollar, what do you make of the overall price reaction this week? About 0.5% from the intra-week lows. Does it seem like a bit of an underreaction given the almost existential scale that auto tariffs sort of assume for Canada?
Yeah, sure. And it's a fair question. I think kind of the direct impact of the auto tariffs will be absorbable to a degree. I don't think it helps CAD, but, I would push back against the idea that, selectively tariffing the auto sector in Canada by indirect terms is existential. I mean, at the end of the day, I think Canada exports somewhere around $50 billion in terms of finalized vehicles and auto parts. The auto parts are being excluded for USMCA partners. So that takes the total number down to $40 billion. And within that $40 billion, it's the amount that's being tariffed is basically limited to non-U.S. content, which we estimate, very roughly speaking, to be about half. So that kind of ultimately does dilute the overall kind of like headline impact of a 25% auto tariff. So I think that generally, again, is absorbable. If you do some kind of like straightforward beta applications, you're talking about, half to 1% in terms of a dollar CAD mechanical ratchet based off of, our tariff playbook. So that in and of itself, I think, is not altogether dire. If you take a step back, though, I still am concerned a little bit more broadly about kind of the big picture. Again, you mentioned the existential. I think the good news here, before I get into that, is that, auto tariffs is ultimately obviously one sector of the broader economy. Yes, it's the second largest export industry that Canada has to the U.S. But at the same time, we here who look at CAD have been much more concerned about the blanket 25% universal tariff against all Canadian exports, which is obviously a much higher degree of magnitude in terms of the impact. So far as it kind of is constrained to the sectoral, the immediate direct fallout, I think, is relatively not as bad. That all being said, I'm still a little bit wary. Obviously, we continue to ratchet up tariffs. Sentiment in Canada has already been hit pretty hard. This obviously isn't going to do any favors. It's just going to exacerbate that further. I would also make the point that this kind of, you've mentioned stacking the sectoral tariffs. That's very much the case for Canada. Canada remains one of the economies that is kind of like disproportionately exposed or vulnerable to sectoral tariffs. So if you think of auto tariffs, energy tariffs, lumber tariffs, steel and aluminum, Canada is kind of like in the top 3 exporters in terms of like U.S. import share. So there's all, these things become additive over time. And again, it's just going to kind of continue to hurt sentiment locally, I think, and that is problematic. And then finally, I would say, there are some very interesting comments from the new Prime Minister, Mark Carney, this week, talking about fundamentally reimagining the Canadian economy, dramatically reducing, the reliance on the U.S. So this kind of pretends more structural shifts, and without getting too much into the weeds right now, I think ultimately that makes the medium-term case for CAD, kind of concerning for me. There's going to be some kind of, worse before it gets better kind of dynamics if this process, structural process is to go ahead. You're seeing some of that already. Canadians are talking about tearing down intra-provincial trade barriers, which I think is on net a good thing. But at the end of the day, I think that's kind of like a, multi-quarter, multi-year process to really kind of reap the benefits of that. And in the meantime, it's going to be a lot of kind of structural friction and, trade pain, I think, with the U.S. So still kind of a murky picture for Canada, even though right now we've only been delivered, the kind of the diluted auto tariffs. So a lot going on here, I still think, above and beyond just auto tariffs.
Thanks, Pat, for that uplifting message. You are a ray of sunshine today. Just pivoting then to you, Meera, for some better news, hopefully. What are you making of the overall FX impact of these auto tariffs? And seated in Europe, how much of a dent do you feel it makes in the constructive Euro story that you've been telling for the past few weeks?
Sure, Arindam. I usually don't find myself on the more optimistic side of the spectrum, so this is highly unusual for me. But yeah, I am a bit more optimistic on Euro. I think for the Euro, it's just worth taking a step back and thinking about the linkages, what these linkages are for the Eurozone to the auto sector. And some statistics from our economics team. If I look at auto exports to the US as a percentage of local Eurozone GDP, it's not actually that large. It's 0.3% of GDP. The German share is larger at 0.8%, but that still pales in comparison to, say, Mexico, which is nearly 8% of local GDP, or Canada and South Korea, which is 2.5% of GDP. So I think the starting point is that, yeah, the auto sector is important to Germany. It's important to the Eurozone, but the shares, in contrast to some of these other countries like Mexico, Canada, and South Korea is actually much smaller, and even Japan for that matter. Now, if you ask our economists to estimate what the growth impact could be from 25% auto tariffs on the Eurozone, that probably takes off only about a tenth or so from Eurozone GDP. And again, that's not that large, especially if you consider that most economists have already incorporated some sort of tariff hit into their growth outlook. So even if you for instance, look at our own economists, Greg Fusesi has penciled in about 1 percentage point of Eurozone GDP in 2025 and 2026 cumulatively for tariffs. That's a placeholder that's already built into our growth outlook. And I think that's the case for most economists out there as well. So I don't think that the auto tariffs itself is going to be enough to actually warrant a rethink of this large growth hit that people already have penciled in. And also, let's not forget that, the fiscal U-turn from the region is also a major offset. And that's something that's going to have a multi-year sort of longevity to it. And we have previously estimated that the new fiscal commitments could be worth anywhere between, 3.5% to 5% on euro-dollar higher. So again, a tenth of GDP, off of Eurozone GDP because of these auto tariffs is only going to be a small portion of that. So I'm personally not putting too much of weight on the auto tariffs becoming a problem for our otherwise more constructive euro view.
Okay, that's interesting. But just on the back of that, one question that has come up in client conversations this week is just about this notion of how much of a tariff hit is the euro pricing at this stage. And is there at all any amount of threshold tariff hit that will start to impact the Euro USD, even in the presence of this fiscal offset? I guess the question comes on the back of press articles suggesting that the EU trade rep came back from his DC meetings, picking up vibes that Europe could be tariffed at 20%, for instance, on average next week. So how do you think about the tariff pricing question for the euro?
Yeah, I think that's a very important question. Obviously, April 2nd is going to be keenly watched, but I do think it'll depend on what is actually announced. Now, the way I'm thinking about tariffs, if you get sectoral tariffs, as we've discussed, that's a smaller portion of it. But say we get 10% tariffs on all exports from the Eurozone to the US, our usual rule of thumb would suggest that should take off 5% off of euro dollar, so it should weaken the euro dollar by around 5% or so. Now, we've also spoken about the new fiscal element that's offsetting that, and we've talked about how that could be worth around 4 or 5% as well for euro dollars. So I think it's fair to say that if we get 10% tariffs on all of exports to the US, and then you get this new information of actually you're getting all this fiscal spending as well, then you basically have it's net a wash, and I think a net neutral for the euro dollar at around current levels, setting aside some market volatility. Now, I think that situation changes if tariffs are larger. Say we get this VAT equivalent tariffs of 20%, and also the one that you mentioned by some officials. Now, that's admittedly not priced in, and I think that can become certainly an issue for euro dollar bulls. I think an additional 10% is worth an additional 5% weakening in euro dollar. So in the limit, if 20% tariffs are announced, you should get the fair value of euro dollar declining to something like 103.50. That's 5% weaker than current fair value. But I think the question we have to ask ourselves is, how will the market deal with the lack of visibility on the shelf life for such tariffs? Now, if these tariffs were sort of put into place at 20% and then they're lasting till perpetuity, then absolutely we should be looking for euro dollar to get down to sort of the 103, 104 levels. But, to the extent that there is some possibility of a negotiated outcome, and maybe the market is maybe willing to price in only 50 to 60% odds of these 20% tariffs, then the fair value of euro dollar doesn't really decline that much. It's probably closer to 106 or 106.50. So I think we have to keep that in mind. It's not just about that initial announcement. Of course, if it's 20%, the fair value for euro dollar should be considered to be much lower at 103.50. But I think the reality will be, given that there's such a lot of back and forth on where these tariffs will ultimately settle, I think the market's going to struggle struggle to price that in completely. So we are cautious. I mean, I don't want to sort of leave the impression that we are not at all concerned about the upcoming date and the outcome. But in our minds, the fiscal provides a substantial offset. The slowdown and the moderation in U.S. growth itself is also providing a substantial offset. And then the possibility that these tariffs could be ultimately negotiated down also provides an offset as well. So I think considering all of that, if you have a slightly more medium-term view, I think the bullish narrative around euro-dollar stays intact. It's just the near-term, risk management, which becomes a bit more problematic here.
Understood. So that's interesting. It seems like as we move from west to east on this conversation, views tend to become maybe a little more optimistic, certainly within the DMFX space. I'm leaving China out for the moment. Because sitting here in Asia, we saw a similar sort of price action in yen as we've seen in Canada and the euro, which makes sense at first glance because Japan has this auto sector linkage to the US. But just as you are thinking that this may not stick for euro beyond a point, I think we have more conviction in saying that in yen, this just looks wrong. I understand the knee jerk, but the yen is not Canada, the yen is not euro, the yen is not MEX. We do know that the market is positioned reasonably long of yen at this stage, but dollar yen is overshooting real rate differentials. The US-Japan real rate gap is falling against the dollar in favor of the yen with every passing week. But even just setting aside technicals for a moment and just talking about this auto tariff situation, one principal differentiating factor for Japan vis-a-vis other automakers is that it is shielded from this phenomenon to some extent because of the heavy offshoring of Japanese car production, which itself is kind of a legacy of this 1980s trade conflict with the US and the Plaza Accord and its aftermath, right? So our Japanese strategists feel like that the hit to the trade balance is likely to be relatively small, certainly relatively small compared to the financial flows that can take place in the aftermath of these tariffs. And those financial flows can be, many times the current account effect. So for those financial flows, I think two factors regarding the yen are important to track. First, you ask yourself, is enough damage being done to the Japanese growth outlook whereby BOJ rate hiking expectations can be pared back? And our answer at this stage is not really. Yes, there is a corporate earnings channel of growth weakness, but even today we got Tokyo CPI, which came in above consensus. The phenomenon of this virtuous wage price spiral that the BOJ has been talking about is now so entrenched that you feel like the timing can be adjusted a little bit depending on global developments, but the path that the BOJ is on in terms of normalizing policy, which by the way is still incompletely priced into the market, at least for 2026, suggests that the JGB yield support to the yen will not erode materially anytime soon. And then second question you ask yourself is, if these auto tariffs are so important, so critical to at least certain sectors of the Japanese economy, can the equity weakness result in FX weakness? And what we know from the history of Nikkei dollar yen relationships is that while unstable at times, by and large, this link is positive, i.e. Nikkei lower, dollar yen lower. And that's intensified by global drag. So if you have blowback effects onto US growth and, for example, US equities themselves are lower and US yields are lower, all of that serves to actually strengthen the yen rather than weaken the yen against the dollar. So I feel like, at least in this instance, the knee-jerk won't sustain, but perhaps too many people are too bullish of yen at this stage, and maybe the market needs a bit of sort of natural cleansing for that view to play out.
While you got the mic, Arindam, maybe one more question for you. Something we've heard from clients is that on a kind of a more benign tariff delivery, can you get a U.S. everything up scenario, i.e. dollar up, yields up, equities up? Is that a situation that you can kind of envision yourself?
It has come up in conversations for me as well, and I suspect not, because I think that everything up scenario in the US, certainly for stocks and bond yields, kind of ignores what happens to the rest of the world in that scenario. And in the rest of the world, ultimately, we are talking about a greater potential hit to rest of the world growth outlook from these tariffs. than in the US, which is being shielded by these carve-outs and such that you talked about, right? So if the rest of the world is going to squeeze higher in terms of risk compared to the US, then that world of higher US stocks, but even higher rest of the world stocks starts to resemble the value of the dollar smile, which has historically been the most corrosive for the dollar. And I think you can make a similar argument for yield differentials as well, right? With the one additional nuance, which is what I flagged at the outset. For the US, you can get a backup in nominal yields, but at least at the front end of the curve, US real yields are probably going to remain a durable drag on the dollar. And I think that just owes to the way the Fed has adopted its asymmetric dovish stance. I just don't see an easy solution for the dollar out of this conundrum, so long as we are in the middle of this kind of tariff conflict. As for both of those reasons, I feel like in a benign outcome, you're probably going to get your kind of classical risk on dollar lower kind of result, even though we fully acknowledge that the overhang of the dollar in terms of valuation, sentiment, positioning is nothing nearly as extreme as it was before the Trump inauguration. A lot of that cleansing has happened, and therefore what we get from here may be a little more slower grinding in nature. So let's leave it there for this week, guys. Thanks so much for joining this podcast. Thanks to our audience as well for listening in. This communication is provided for information purposes only. Please refer to JP Morgan research reports related to its content for more information, including important disclosures. 2025, JP Morgan Chase & Company, all rights reserved. This episode was recorded on March 28, 2025.